3 out of 55. That's the number that should stop you cold. According to data from Alfractal, only 3 out of 55 major altcoins have outperformed Bitcoin over the past 60 days. 3. The rest have lost between 20 and 80% of their value relative to Bitcoin. Meanwhile, Bitcoin dominance has climbed past 60%, the highest level since mid-2021, and the Altcoin Season Index is sitting around 25 to 29, which means we are deep inside what analysts call Bitcoin season. If you're holding a portfolio full of altcoins right now, you already know what this feels like. You open your app, you see red everywhere, and the one green candle belongs to the asset you thought you were being clever by diversifying away from. So the question today is brutally simple. Is this the moment to rotate into altcoins before the next explosive move? Or is it time to consolidate into Bitcoin and wait? By the end of this video, you will have a framework, real data, and specific numbers to make that decision. Not hype, not hopium, math. Bitcoin is trading between $65,000 and $70,000 as of early 2026. That sounds respectable until you realize it represents a nearly 50% correction from its October 2025 all-time high above $126,000. But here's what makes this drawdown different. Bitcoin isn't crashing into oblivion. It's stabilizing, holding its 50-week exponential moving average. Institutional money is still flowing in. The U.S. Strategic Bitcoin Reserve, established by executive order in March 2025, represents a structural government endorsement that literally did not exist in any previous cycle. Bitcoin has a floor under it that altcoins simply do not. While Bitcoin absorbs selling pressure like a heavyweight taking body shots, the altcoin market is getting knocked out round after round. The Bitcoin Dominance Index hit 60.74%, up from 59% at the end of September 2025. Every percentage point it gains represents billions rotating out of altcoins and into Bitcoin. The crypto market is a building with 100 rooms, and right now, 60% of all the money is crammed into one room labeled Bitcoin. The other 99 rooms are splitting the remaining 40%, and most are nearly empty. The Altcoin Season Index, tracked by Blockchain Center, measures how many of the top 100 altcoins have outperformed Bitcoin over a rolling 90-day period. Above 75 means alt season. Below 25 means Bitcoin season. Right now, it's hovering around 25 to 30, and it dropped as low as 12 earlier in this cycle. That means fewer than 12% of top altcoins could even keep pace with Bitcoin. If alt season is a party, the DJ packed up, the lights came on, and someone's mopping the floor. Now, some of you are thinking this is just the cycle. Altcoins always bleed against Bitcoin before they rip. You're not entirely wrong. Let me walk you through the anatomy of this cycle, because the pattern is more structured than most people realize. The current cycle traces back to November 2022, when Bitcoin bottomed at approximately $15,500. Phase 1 ran through late 2023. Bitcoin surged to nearly $39,000, a 151% gain, while most altcoins barely moved. Phase 2 kicked in during the first quarter of 2024. Specific sectors started showing life, particularly Layer 1 blockchains and AI tokens. The Altcoin Season Index briefly crossed 75, but it was a flash, not a trend. Phase 3 arrived in late 2024. By December, the index peaked at 88. XRP, Cardano, Solana all posted significant gains. Crypto Twitter was euphoric. Except, the majority of altcoins still underperformed Bitcoin, and the rally evaporated as fast as it appeared. It was a selective mini-rally, not broad-based alt season. Phase 4 is where we are now. Since early 2025, relative strength has shifted heavily back to Bitcoin. This pattern is driven by three forces: capital rotation, risk appetite, and liquidity. When macro uncertainty is high, money flows toward the most liquid, most institutionally supported asset. That's Bitcoin. Altcoins are risk-on instruments. They perform when confidence is high and liquidity is abundant. Right now, confidence is not high. Trump's announcement of plans to raise global tariffs to 15% rattled risk sentiment across every market. Geopolitical concerns around Iran added another layer of uncertainty. The Fear and Greed Index has been in extreme fear territory for weeks. Polymarket indicates a 75% probability that Bitcoin falls below 55,000 at some point during 2026. But here's where it gets nuanced. The question isn't just, are altcoins dying? It's which altcoins are dying, and which ones are quietly building the foundation for the next move. Even in the most brutal Bitcoin-dominant phases, there are always pockets that decouple. Right now, three sectors are showing signs of life: real-world asset tokenization, artificial intelligence tokens, and select DeFi protocols. The RWA space is maturing rapidly, with institutional momentum accelerating from pilot programs to production-grade infrastructure. This is BlackRock and JP Morgan territory. Chainlink is seeing deepening institutional adoption, specifically because of its role in RWA tokenization. On the AI front, tokens connected to actual computational infrastructure have shown resilience. And Solana, despite getting hammered in February with a 39% monthly loss, still has 27.1 million active addresses and is rolling out its Alpenglow upgrade with 150 millisecond finalization. The fundamentals haven't broken, the price has. This distinction between price destruction and fundamental destruction is the single most important concept before we go further. A token down 60% because the entire market is risk-off, but still has growing network activity and institutional interest, is fundamentally different from a token down 60% because nobody uses it and the team stopped building. The first is a potential opportunity. The second is a funeral. Most people in crypto can't tell the difference because they're looking at charts when they should be looking at data. The macro picture makes this cycle uniquely treacherous. Bitcoin didn't crash because of a protocol failure or exchange collapse. It crashed because global risk appetite contracted. Tariffs, war rhetoric, regulatory uncertainty around the Clarity Act. According to Oanda's March 2026 analysis, the US-Iran conflict continues to drag on risk sentiment, but surprisingly, hasn't led to worse crypto performance. That word, surprisingly, means Bitcoin is showing resilience the bears didn't expect. And resilience during macro stress is exactly the signal that precedes the next leg up. Standard Chartered slashed its Bitcoin prediction to 50,000, which sounds bearish until you realize the last time sentiment was this negative was summer 2022, right before the cycle bottom. What usually happens when Bitcoin stabilizes after a major correction while maintaining institutional support is that dominance eventually peaks, rolls over, and capital flows back into altcoins. The question is timing. Let me give you a concrete example of why timing matters more than conviction. In January 2018, Ethereum was trading at roughly $1,400. Bitcoin dominance had just bottomed at 33%, and alt season was in full swing. Someone buying Ethereum at that moment with total conviction that it was a generational asset would have been correct about the technology and catastrophically wrong about the timing. Ethereum dropped to $80, a 94% drawdown. It took 3.5 years to recover that price. The person who waited, who watched dominance stabilize, and then bought Ethereum at $150 in late 2018, made roughly 32 times their money by the 2021 peak. Same asset, same thesis, radically different outcome because of entry timing. That's the game we're playing right now. Being right about which altcoins will lead the next cycle is only half the equation. The other half is not being early, because in crypto, early and wrong feel exactly the same. There's another dynamic that doesn't get enough attention, and it's the supply dilution problem. During the last bull run, the total number of tokens listed on major exchanges roughly doubled. We went from about 10,000 trackable assets to over 20,000. Every new token launch siphons liquidity from existing altcoins. It's like pouring the same glass of water into more and more cups. Each cup gets less. In 2021, there was enough speculative capital flooding into the market to fill those cups anyway. In 2026, with tighter monetary policy and institutional money laser-focused on Bitcoin through ETFs, there simply isn't enough retail FOMO to go around. The altcoins that survive this environment will be the ones that generate their own demand through actual usage, not just hype cycles and influencer shills. Think about it this way. Uniswap processes real trading volume and generates real fees. Lido manages real staked assets. Aave facilitates real lending. These protocols have income. Compare that to the hundreds of tokens that launched with a flashy website, a Discord server full of bots, and a roadmap that reads like a wish list. When liquidity contracts, the market becomes Darwinian. The strong eat the weak. And right now, the strong are getting stronger, while the weak are quietly flatline. Here's a stat that should frame your thinking. According to CoinGecko data from February 2026, roughly 68% of all altcoins that existed during the November 2021 peak are now trading below their ICO or launch price. Not below their all-time high, below the price people paid on day one. That means for the majority of altcoins ever created, there has never been a profitable exit for the average buyer. Let that sink in. The narrative that altcoins always come back is survivorship bias. You remember Solana's recovery from $8 to $260 because it's a headline. You don't remember the 2,000 tokens that went from $8 to $0 because nobody wrote an article about them. Here's where we stop talking theory and start talking strategy. 3 scenarios, rough probabilities, and concrete moves. Scenario 1. Bitcoin consolidates between 60 and 70,000. Dominance keeps climbing towards 65%. Altcoins bleed for another 3 to 6 months. 45% probability. Macro headwinds haven't resolved. Tariff policy is in flux. The Clarity Act is stuck. The Fed hasn't committed to rate cuts, and tight liquidity is kryptonite for altcoins. Playbook. Overweight Bitcoin to 60 to 70% of your crypto portfolio. Keep 10 to 15% in stablecoins as dry powder. Limit altcoin exposure to 15 to 20%, concentrated in RWA, AI infrastructure, and battle-tested DeFi protocols with real revenue. Aave processes billions in lending volume. MakerDAO generates real yield from real-world collateral. Protocols with income statements, not just white papers. Scenario 2. Bitcoin breaks below 60,000, testing the 50 to 55,000 range. 30% probability. If Bitcoin drops another 15 to 20%, altcoins don't bleed, they hemorrhage. Another 30 to 50% downside on tokens already cut in half. In 2022, Solana went from $260 to $8, a 97% drawdown. If you think it can't happen again, you haven't been paying attention. Playbook. Full defensive. Bitcoin at 70 to 80%. Stablecoins at 20 to 30%. Altcoin exposure at 0. You can always re-enter later. You cannot unlose capital you didn't protect. Scenario 3. Bitcoin holds its range, macro stabilizes, the Fed signals dovish intent, dominance tops out, and capital flows back into altcoins. 25% probability, the lowest, because the preconditions haven't been met. Every major alt season has been preceded by a specific sequence. Bitcoin rallies, dominance peaks, dominance declines, then altcoins rip. We saw it in 2017 when dominance dropped from 95 to 37%. Again in 2021 when it fell from 73 to 39%. Right now, dominance is still climbing. It hasn't peaked. Buying altcoins before dominance turns is like jumping onto train tracks because you heard a train might be coming. But if dominance does top out while Bitcoin holds above 60,000, the rotation can be violent and fast. In December 2024, some altcoins posted 40 to 60% gains in under 2 weeks. So how do you position for scenario 3 without getting destroyed by scenarios 1 and 2? Staged deployment. You build positions in tiers based on trigger events, not gut feelings. Tier 1, starting now, is research. Identify 10 to 15 altcoins with the strongest fundamentals, growing on-chain activity, real institutional partnerships, upcoming catalysts, and tokens already down 70 to 85% from highs, but with active development and clear revenue models. Build a watch list. Don't buy yet. Tier 2 triggers when Bitcoin dominance stops making new highs for 3 consecutive weeks and the Altcoin Season Index crosses above 40. Deploy 25% of your altcoin capital into your top 5 picks. Tier 3 triggers when the index crosses above 60 and dominance confirms a downtrend on the weekly chart. Deploy another 25%. Tier 4 fires when the index crosses 75, confirming broad alt season. Deploy the remaining 50%. This removes emotion from the equation. You're responding to data with pre-planned actions. And if the triggers never fire, you've preserved your capital. Now, let me address the psychological trap that destroys more portfolios than any bear market ever could. It's called anchoring bias, and it works like this. You bought an altcoin at $5. It ran to 20. You didn't sell because you were sure it was going to 50. It dropped back to 5, and you held because you remembered 20. Now it's at $2, and you're still holding because selling at 2 when you saw 20 feels like admitting defeat. Here's the brutal truth. The market does not care what price you bought at. It does not care what price you saw on screen 3 months ago. The only question that matters is this. If you had the cash equivalent of your current position right now, would you buy this token at this price with what you know today? If the answer is no, you are holding out of ego, not strategy. And ego is the most expensive asset in crypto. It pays 0 yield and costs you everything. I want to give you a practical filtering system for your Tier 1 watch list because do your research is the most useless advice in this space unless someone tells you what to actually research. 5 filters. First, revenue. Does the protocol generate fees that accrue to token holders or the treasury? If not, skip it. Second, active addresses. Not total wallets created, but daily and weekly active users. Is the trend up, flat, or down over the past 90 days? If it's down, that's a red flag, even if the tech is impressive. Third, developer activity. Check GitHub commits. Are developers still shipping code, or did the repo go quiet 6 months ago? A dead GitHub is a leading indicator of a dead project, usually about 6 to 12 months before the price reflects it. Fourth, token unlock schedule. Nothing kills a recovering altcoin faster than a massive unlock dumping supply into a thin market. Check vesting schedules. If there's a major unlock in the next 3 to 6 months, factor that into your entry timing. Fifth, institutional signals. Is this token being integrated into real financial infrastructure? Are there partnerships with entities that have compliance departments and legal teams? If the biggest name associated with a project is a YouTube influencer, that tells you everything you need to know about its staying power. Let me run through this filter quickly with a real example. Take Chainlink. Revenue, yes, it generates fees from Oracle services and CCIP cross-chain transactions. And those fees have been growing quarter over quarter. Active addresses steadily increasing, driven by real integrations, not speculative trading. Developer activity, one of the most active repositories in all of crypto, consistently in the top 5. Token unlock schedule. The Link token has a known distribution, and the team has been transparent about treasury usage. Institutional signals. Adopted by Swift for cross-border messaging pilots, integrated by major banks for tokenized asset settlement, and named specifically in multiple BlackRock filings related to their tokenized fund infrastructure. That's what a fundamentally strong altcoin looks like in a bear market. Compare that to a random layer 1 that peaked during the 2024 meme cycle, has declining active addresses, a ghost town GitHub, and a 30% token unlock hitting in Q3. Same drawdown percentage, completely different risk profile. One more thing before the bottom line, and this is the part nobody wants to hear. Your portfolio size matters for strategy selection. If you're working with under $10,000 in crypto, concentration is your friend, not diversification. Spreading $5,000 across 15 altcoins means you have $330 in each position. Even if one does a 5x, you've made roughly $1,300. That's nice, but it's not life-changing, and the odds of picking the right one out of 15 are slim. With a smaller portfolio, you're better off with a barbell approach, 70 to 80% in Bitcoin, and the remaining 20 to 30% in your single highest conviction altcoin pick. One shot, well-researched, properly timed. If you're working with a larger portfolio, say over 100,000, then the tiered deployment strategy makes more sense, because you can absorb volatility across multiple positions without any single loss being catastrophic. Now the elephant in the room. A significant number of altcoins from this cycle will never recover. After the 2018 crash, roughly 95% of ICO-era altcoins never returned to their highs. After 2022, tokens like Internet Computer dropped from $700 to $3. Filecoin from 236 to under 3. These weren't scams. They were legitimate projects that couldn't sustain adoption in a market that moved on. When Bitcoin dominance is above 60%, there is literally not enough money to support thousands of altcoins. The tokens with the weakest fundamentals get starved of liquidity and slowly die. So here's my bottom line. Right now, in March 2026, the smart move is not to rotate aggressively into altcoins. Dominance is still rising. Macro is still uncertain. Liquidity is still tight. But the smart move is also not to panic sell everything. The cycle hasn't broken. The historical pattern is intact. Bitcoin leads, consolidates, dominance peaks, then altcoins have their moment. We just haven't reached the peak yet. The optimal position is Bitcoin heavy, with surgical altcoin exposure in the 3 sectors showing institutional traction. A stablecoin reserve ready to deploy when triggers fire, and the discipline to wait for data to confirm the move before you make it. The people who get rich in crypto aren't the ones who predict the future. They're the ones who prepare for multiple futures and execute when the signal arrives. Stay sharp, stay patient, and I'll see you in the next one.